Okay.
Black now? Okay.
Yeah, it's black.
Recording in progress.
All right, so kind of let's officially start this gathering. And first of all, I should say for the sake of the recording, this is Coach Chris, aka Christian McFarland. And I really wanted to thank our special guests who are here today, and most especially our friend Arton, who invited the rest of our guests today. And thank you guys for being here. And the purpose of this recording, first and foremost, is for your spouses and or your review. And the topic of today's meeting, as Shanti kind of already introduced, is this is our very, very first, what I'm now billing as a Build a Bank workshop. You should be thinking a teddy bear, right? Like a little teddy bear with a monocle and the banker's hat. That's going to be our logo. Sorry, we don't actually have that together yet. I just got the idea last week, okay? But we're working on it, rest assured, okay? So this is our very first Build a Bank workshop. And you're not going to walk out of here with a cute teddy bear, but you could walk out of here with a much, much better opportunity to retire your debt much, much earlier, as Shanti already said, but more importantly, use the same money that you would have used to retire to get out of debt faster. And also another big theme and another big topic is to learn literally how to set up your own bank and to own and operate your own bank. Now you can do this as an individual in your household. You could do this as a married couple, a family could do this, but it's really the very best for a business. And I'm talking about in the largest sense of a business, right? So, for example, I was just talking with Jatan, who's one of our guests here, and she was saying that her husband owns a couple of trucks and he's looking at purchasing another truck, and I was telling her that reminded me a lot of my son, Andrew, back in Denver, who I was just texting with. Hopefully I'm going to get to go to church with him and his wife tomorrow after they pick me up from the airport. And then, by the way, I'm also looking forward to being a grandpa for the first time, hopefully. Mom and baby doing pretty good so far. Everything's good. But anyhow, the reason I was bringing up Andrew is because he's a business owner, and he actually has a very similar business to what I think a lot of our audience here has today, which is he has trucks. He owns a moving company, and he's got a couple different trucks. They're slightly different trucks than like your over-the-road trucks, right? They're more like moving trucks. But a few years ago, before I had figured all this out, he went and he had saved up a bunch of money, and then he went and he bought a truck, and I was like, proud dad, that's really cool, but gosh, I want to strangle you because you should have put it in the super saver that I have first, and here's why. And this could apply for any type of business expense or any type of household expense. You got a big screen TV you need to pay off that was put on a store card. You got the house itself. You got the car that you drive to the house in. Whatever debts and obligations you have, you could use. So you don't have to be a business, but a lot of people who are here do have a business. So whether you're buying a new truck, whether you're paying off the house you live in, whether you're paying off the car that you drove here in, this would apply. The same logic would apply. So when my son went and spent $20,000 to buy his truck, of course he had it sitting in a bank account, obviously, right? But if he had had it in what I'm going to be talking about, what Shanti referred to earlier as the super saver, and the only thing that you have to do the super saver, so it's a place to deposit money. There's a minimum requirement of how much you have to keep in there, like a minimum cash reserve, just like a high yield savings account. Like you guys might have heard of Dave or Chime or what's the other one? Aspiration.
Aspiration. Yeah.
There's all these different ones. Goldman Sachs has like Marcus. I actually have a Marcus account. I have $1 left in my Marcus account. I started out with $500. This is before I figured out all the stuff I'm teaching you today. And I opened up a quote high yield savings because I was like, hey, Goldman Sachs, that's a great big company. That's a safe place to to keep my money. And they have a high yield savings account. And they were offering me 1% in their high yield savings account. Woohoo! 1%. Well, it is a heck of a lot better than what you normally get in a savings account, right? Okay. As soon as I opened up that account, within 3 months, they lowered it to 0.8, and then they lowered it to 0.6. And I'm sitting there going, well, you sold me 1%, and now it's down to 0.6, and I still have to keep, my money in there or whatever. I'm like, all right, fine. Maybe this isn't really high yield savings account. So fortunately, right about that same time that I was looking for a high yield savings account, my mentor, who I'm going to be talking about briefly in this presentation, a gentleman named David Weiner, who's a legend in the insurance industry. Now, I've been talking about banking, and the way that we're going to set up our own bank, listen carefully now, this is the part you didn't expect, is through an insurance policy. Now, getting back to my point from a second earlier, there is one really big difference about setting up this kind of savings account. Because it's insurance-based, there is a health check. Now, that doesn't mean you have to be an Olympic athlete. It doesn't mean you have to be in any kind of perfect shape. It doesn't mean, that you can't get it if you're a little bit overweight, or even if you've had some negative health experiences in the past. You'd have to have like pretty catastrophic, like you still have cancer, or you had cancer within the last 5 years. There are some things that would cause people to be declined, is what I'm saying, but they're fairly rare. So I am going to be jumping into the presentation. I wanted to do a little bit of an introduction here. Getting back to this idea about the truck that I teach, I got to make this point because it's real important, and hopefully this will be something that'll bring everything together. But the reason I was a little bit mad at my son when he went and spent the $20,000 that was sitting in his regular bank account is because once he spent that, it was gone. Now again, he spent it, he owns the truck. But if he had had the Super Saver account, which he now has, we just upgraded his Super Saver account a couple days ago. It's in the application right now. But he's set up now he's getting ready to go buy a couple other trucks. And he's got $115,000 sitting in a regular bank account right now. What he's going to be doing is transferring that money over to his Super Saver account, and instead of just taking a withdrawal and the money's bye-bye gone, he's going to take his $115,000, I'm going to use a little visual aid here, right? Here's his money, and he put it in his Super Saver account. Now, when he's ready to go buy his truck, or pay his employees to meet payroll, or do anything else he needs to do for his business or his household, he's going to take money out of that account. But he's not going to take a withdrawal. He's going to take a loan. Now, I'm going to talk a lot more about this in the presentation, but there's not going to be any credit check on that loan. He's not going to have to pay that back until he dies. And his money's never left. That means it's still earning interest. Do you see why did I tell the story right? Do you guys see why I was a little bit mad at him that he didn't put it in the Super Saver before he went and spent $20,000 on trucks? Because he could still be making money on what he had done off the original money. And there's a fancy word for that. It's kind of a Frenchy, froggy sounding word, but it's called arbitrage. And don't worry about spelling it. It's not on the test. It's also, you could also call that spread. You could also call that the spread. Okay? So you can have positive spread, you can have negative spread, and we want to make money. So let me go ahead and get into the formal presentation. Shanti, we can go ahead and probably turn that one off, I guess, for now.